Well, the majority of the market has now rapidly swung behind a 75 basis points hike from the Fed today, having been looking at 50 basis points up until very recently. So that's a sharp, sudden swing. And I think that's, on balance, what we're more likely to see, although a 50 basis point move wouldn't be a complete surprise.
So will the FOMC be considering issues differently in light of the changing economic environment?
They're certainly going to be cognizant of some of the signs of weakness that we're seeing in things like the consumer sentiment surveys, for example. And they'll certainly be cognizant of what's going on in the stock market and in the bond market. But nonetheless, they've made it abundantly clear that their mission currently is inflation, and that means they have to keep hiking.
And what about after tonight? Where do you think inflation and rates are heading?
Well, within the US, we think it's a no-brainer that every meeting for the rest of the year will see a hike. The only question is how large that hike will be. You've got people saying there could be 75 today, and then 75, and another 75, and then 50, and another 50, which is quite remarkable. You've got other people saying it could be less. They will tell us themselves today at the end of their meeting, on balance, what they think they will be doing. So that's probably the best guide for now, unless the data or the markets change dramatically.
So what will be the implication for US equities? We know that we are technically now in a bear market. And what about for global stocks more generally?
Well, for both of them, it's bearish. You've got winners and losers always, sector by sector, country by country. But generally speaking, if interest rates are going up aggressively to try and slow down demand, at the same time as we already have demand being slowed by an increase from the supply side, taking hundreds of dollars out of your pocket every month for energy bills and food, for example, and higher mortgage rates, it can't be good for discretionary spending. And so stocks will remain in a bear market.
Well, we know bond yields are spiking globally. We saw that brief inversion of the curve in the US this week. Does that spell recession?
We think it does. The only real question at this point is, when does the recession kick in and how deep is it? And I have to tell you, within markets, economists, whether they work for banks or hedge funds or pension funds, they are pretty loath to actually call a recession. It's very difficult to prize one out of the market. They tend to be too late and then far too optimistic in terms of pricing in just how deep it will be. But if you look at the destruction in purchasing power that's happening right now, and that increase in rates as well, it really is pretty ugly.
It seems that commodities are being bought right now as an inflation hedge. How long do you expect that to last?
Well, that's a different question, because what we have in commodities is a very interesting dynamic. Interest rates are going up, which is bad for bonds, and it's bad for equities. And the US dollar is going through the roof. And you would think commodities would come crumbling down. They're not. Most of them are holding up very, very well. And energy in particular is just moving higher and higher. We had one little dip yesterday, but the trend is still up. Now, that tells us things have changed structurally. And partly that's due to the war in Ukraine, and partly it's due to changes in the global economy overall. They can probably hold on. But my view is one of the things the Fed is aiming its bullets at are commodities.
How is the US geoeconomic and geopolitical pressure playing into the economics of all of this?
I think it's a huge part of it, and it's something that not enough people in markets are talking about, because A, it's not something they normally look at, and B, it's deeply uncomfortable when you do look at it, and it's not their area of specialization. But very clearly, to my mind, part of the crunch that we're getting in supply chains, whether it's commodities or even in some manufactured goods, is geopolitical, because you openly have a certain subset of countries saying they don't like the global system, the global order, and the global rules. They want new rules and a new order. They're using supply chains to try and achieve that. And so one of the things I was alluding to a moment ago is that I do believe that the Fed has a geopolitical purpose in raising rates, because that will push up the dollar, the US dollar. Eventually, that will do to commodities, or many commodities, what it's already done to crypto. And of course, it will cause tremendous pain to emerging markets, to developed markets, right the way around the world, which is when the Fed is likely to then step in with what we call swap lines, where they say, you give us your currency, we'll give you dollars. No questions asked. We just swap them. So if you're in the US camp, you'll get hold of dollars and you don't have a liquidity crunch. If you're not in the US camp, you'll be crunched. So I expect to see that happening going forward. And fundamentally, what we have to realize now is that most of the economics we've been looking at, most of the economists we listen to, whether they're working in markets or in treasuries or central banks, none of them have focused on the supply side for far too long. They're focused on the demand side.
Michael Every, thank you.
Thank you.